everyone, welcome back to the Audit and Attestation class. This is a new topic, misstatement and internal control deficiency. So in this topic, or specifically in this session, we'll be covering in detail about the misstatement and internal control deficiency and the type of internal control deficiency. This is part 1 of the misstatement and internal control deficiency. Please go through the part 2 as well, which is coming just after this.
First major topic of the day, which is misstatement and internal control deficiency. So the topic is 4.5, misstatement and internal control deficiency. First, we'll be understanding misstatement. Can you all see my screen?
Yes, sir.
Yes, sir.
Okay. So misstatement are actually of two types. One misstatement which management agree and they correct it, and one misstatement which management do not agree or they do not correct it. So it has been divided into two parts: corrected misstatement and uncorrected misstatement. If misstatement has been corrected by the management, then what as an auditor we need to do? We need to ensure like appropriate documentation of the same. Right, how we have identified that misstatement and what discussion we had with management and what appropriate journal entries or accounting treatment that management has taken and the supporting document of that. And then there's no additional impact on the opinion, neither the impact on opinion nor the impact on financial statement disclosure. Right, makes sense? If you have identified any misstatement, if you have identified any gap and management agree to it and management has corrected it and make the financial statement update, then you are not required to take any impact on your opinion. Make sense? Yes, no?
Yes, sir.
Yes, sir.
Second thing is difficult management. When you have identified certain misstatement but management is not agree to consider the impact of the same in their financial statement. So there are two types of misstatement. One is known or factual misstatement and second is likely or projected misstatement. Known or factual misstatement, if you remember from yesterday example we were discussing, like management has paid, let's say, insurance of $100,000 for a year and they book the entire $100,000 as an expense, whereas like they have taken insurance, let's say, in mid of the year. So they are supposed to book $50,000 as an expense and $50,000 should be prepaid. Right? Make sense? That's how we do journal entries for the advance payments.
Yes, sir.
Yes, sir.
And this is what kind of mistake? It's a factual mistake where like application of accounting standard is incorrect. You know the facts, you know the figures, you know the numbers, you know exactly what is right and exactly what is wrong. Right? So these kind of misstatement are called factual misstatement. When there is no doubt like omission or any disclosure or application of accounting principle, those kind of misstatement are called known or factual misstatement. Second category of misstatement is likely or projected misstatement. Likely or projected misstatement, like for example, any litigation matter. In the litigation matter, management will always say they will win the case. Right? You have done like you have done the inquiry with the legal counsel, you have taken a confirmation from the legal counsel, and then maybe like you have involved your own legal team to review, and you come to the conclusion, no, there is a potential outcome from this litigation for the company. So this is kind of judgmental, right? Where you do not know exact amount, exact situation, because things will be happen based on the future outcome. So those kind of misstatement, for example, if you have identified the company need to make a disclosure of, let's say, $100,000 for any litigation claim or assessment, whereas management says, no, we don't agree to you. And basis on our previous experience, these kind of cases are does not substantiate long, and company generally win in this kind of litigation. So there's a difference of opinion. So difference in estimation. Right. Second, maybe like for example, provision for doubtful debt. So company has made, let's say, 1% provision for doubtful debt for account receivable pending more than 30 days. And whereas you have seen like in previous year, couple of year experience, that company end up incurring 2 to 3% actual bad debts. So here you will be requesting management to consider 2% or 3% as a provision for bad debts, whereas management consider 1%. So there is like, again, like projection, there's an estimation, right? There's no absolute number which as an auditor you can comment, right? Your judgment says it should be 2% or 3%, whereas management judgment says it should be 1%. So there might be a differences, right? Make sense? So those kind of differences which are uncorrected are called likely or projected misstatement. So what is known or factual misstatement? What
So
is
when we know
known?
that the accounting principle is not accurately applied.
When you know, when you have no doubt about like omission or application of accounting policies or principle, right? And what is likely or projected misstatement?
Like when there is an change in the like difference of opinion between the estimate that the management is making and we are making, then that's a likely or projected misstatement.
Yeah. And what you need to do in corrected misstatement?
So there's we should do documentation and there should be no impact on opinion.
So most important thing is documentation. So we need to ensure appropriate documentation when there is corrected misstatement or uncorrected misstatement. Both the cases, documentation should be sufficient to justify what stand you have taken, right? Now let's understand the theory. The auditor should determine whether the overall audit strategy and audit plan need to be revised if the nature of identified misstatement and circumstances of their occurrence indicate that other misstatement may exist. So when you identified certain misstatement, so you need to look at whether there is change in overall audit strategy or audit plan required, or there is any change in audit strategy and audit plan for the respective financial statement line item required. And if required, then you need to update that plan and perform the additional audit procedure, right? Second is auditor should evaluate effect of misstatement, both quantitative as well as qualitative, right? There might be a misstatement which may not be so much significant material, but it may reflect that intent of the management is biased, right? Or you can say the risk of fraud. Maybe the amount may not be bigger. Whereas, let's say, a small cash embezzlement. So you have seen, like in the books of accounts, company have a cash in hand of, let's say, $100,000. But when you have visited surprisingly to do the cash count, you have seen the cash in hand of the cashier is, let's say, $80,000. And for $20,000, which is short of cash, he or she do not have bills in it, right? Even though amount may not be material, but it may show the risk of fraud, risk of misappropriation of the fund, or risk of embezzlement of cash. So in that case of scenario, you need to plan additional audit procedure for the respective financial statement line item. So the effect in relation to the relevant individual class of transaction, account balance, presentation or disclosure, the effect of misstatement on financial statement as a whole, and the effect of misstatement related to the prior period. So all those things you need to consider when you identified any misstatement, whether it is corrected or not, that is separate thing. But as and when you have identified any material misstatement, it's being your responsibility to look at right, left, and center. What is right, left, and center means? Like the impact on the current account balance, transaction, or presentation disclosure related to that specific financial statement line item, and impact on the overall financial statement and the related prior period, right? So all those things you need to look at it more skeptically, right? Third is qualitative factor that auditor should consider if you have identified any misstatement. First one is potential effect of the misstatement on trend. Let's say month on month journal entry. So every month and management is posting, let's say, any fake journal entry or bogus journal entry to inflate their revenue or to inflate their profit or to increase their expenses, like depend on like the management intention or management objective to achieve from those financial statement, right? So there you need to look at like how the management, if the management has committed any fraud or overriding, so what all kind of impact that may have on the overall financial statement, right? And the trend as well on period over period, how those, you can say, journal entries or management overriding of control is impacting period over period. Second is misstatement that change the financial position. So there might be possibility that company may make or management may make a journal entry which may change the overall financial position from loss to profit or profit to loss, right? Those kind of, you can say, misstatement, you need to be more rigorously look at it, and more quantitatively or qualitatively look at it with more professional skepticism. Third is potential effect of misstatement on the entity's compliance with loan covenant, other contractual agreement, and regulatory provision. So these are qualitative factors which probably in terms of number you may not see it, but in terms of quality of maintaining and continuously getting those respective funds that management are required to maintain. So whenever you get like any secured loan or unsecured loan for the business purpose, right, there are certain covenant. You know what is debt covenant? Any idea? Huh? Rahul, Nimisha, Ayush, Kush, do you have any idea what is debt covenant?
Debt covenants are conditions in the debt agreements. For example, very lame example, but current ratio should be 2:1. Or financial leverage ratio should not go below a certain limit, something like that. And if we don't adhere to those covenants, then that leads to breach of debt agreement.
Yeah.
And then action can be brought against.
Yeah, absolutely true. Absolutely true. So whenever you get any business loan, whether it's secured loan or unsecured loan, bankers, or you can say lender, put certain condition. You need to maintain certain debt turnover ratio. You need to maintain certain working capital. You need to maintain certain current ratio or liquidity ratio, interest coverage ratio, those kind of things, those kind of covenant that generally lender put on the company, right? Same way, like if you get any grant or fund or financial assistance from the government for any activity, there also they put certain condition which you need to satisfy, right? So those all things you need to keep in mind as a qualitative factor when you are evaluating the financial performance of the company, right? Next is statutory and regulatory reporting requirement. So, for example, if your company has given received grant or financial assistance, they need to go through with the single audit requirement as well, in addition to the financial statement audit requirement. So those all things you need to keep in mind. Next one is misstatement that masks a change in earning or other trend. So there might be a misstatement which may, you can say, upfront see like it is changing the loss to the profit or profit to the loss, right? Those kind of, you can say, transaction or maybe strategic transaction, you need to evaluate more skeptically. So there might be possible, like for example, the company has taken a big tender. Just for the strategic purpose, the tender will give them edge over the competition, but overall the tender has resulting into the loss kind of contract, right? In that case upfront it may see like it's a big revenue contract, but in substance if you see it's a loss making or onerous contract. So in that case of scenario, you need to ensure the company is booking the loss upfront for those kind of onerous contract. Make sense? Yes, no? Okay. Next one is a misstatement that has the effect on management compensation, bonus or incentive, like performance linked bonus, right? So there might be chances of fraud. There might be chances of fraud on account of pressures, incentive, or all those fraud triangle reasons like pressure, incentive, and opportunities. That management try to inflate the overall financial performance to achieve their bonus, incentive, ESOPs, and other compensation. So those kind of things also you need to evaluate critically. These all are qualitative factors which you need to consider when you are evaluating the misstatement. G point is sensitivity of the circumstances surrounding the misstatement. So non-compliance of the law or regulation, how severe the impact would be. Right. For example, if company is in, like, let's say tobacco, alcohol, food and beverages, drugs, or you can say medical equipment, those kind of industry, which is like highly regulatory environment. And if they do any non-compliance of any law or regulation, so that may have severe impact, even though they require to shut down their operation if they do not comply with those specific norms required by the respective industries as per the government. Right? So you need to understand the sensitivity of those circumstances surrounding the misstatement that may result on account of non-compliance with any law or regulation. Same way, violation of contractual provision. For example, your company has got a contractual arrangement with your biggest customer. Let's say Amazon is your biggest customer and you're providing some, let's say, cloud computing services to Amazon. So you have like done an exclusive deal for Amazon. And later on, you find some other customer who is ready to pay you better. And you have shared that IP, or maybe like you have shared IP, or you have shared the services with the other person who is a competitor of Amazon at the better price. Right? In that case of scenario, you are violating the contractual provision which you have made an exclusive provision with the Amazon. Right? So that may result into a significant impact on the overall financial statement of the company. So qualitative factors are very much important to evaluate along with the quantitative factor when you identified any misstatement. Right? H point is significance of financial statement element affected by the misstatement. So how significant that you can say misstatement is impacting that financial statement, that is something you need to evaluate. Next is effect of misclassification. So whether the misstatement is on account of misclassification, right? Your current asset has been classified as a non-current assets, right? Or maybe in your repair and maintenance expenses, like for example, capitalization of repair and maintenance expenses. So wrongly, if management has classified repair and maintenance expense into the property, plant and equipment, and then now you have identified those expenditure are not the capital expenditure, those expenditure are revenue nature. Right? So then you request the management to do the reclassification from property, plant and equipment to repair and maintenance expenditure. Right? So those kind of, you can say, misstatement or misclassification, you need to evaluate. Then J point is significance of the misstatement related to the user needs, like earning to the investor, equity amount to the creditor, and so on and so forth. Right? Degree of subjectivity through estimation, allocation, or uncertainty. So here, when you have like third category of misstatement, what was that? Likely misstatement or projected misstatement. In that case of scenario, you need to evaluate the degree of subjectivity involved through the estimation and how you have allocated that amount. That also required an estimation or the uncertainty of the respective event to be happen or not to be happen in future. Next is motivation of management with respect to misstatement, like indication of possible pattern, unwillingness to correct misstatement, not to follow applicable financial reporting framework, or existence of any offsetting effect. So there might be like misstatement you might have noticed, but that have got offset by other debit balance or credit balance and may not reflect appropriately in the financial statement. So there might be chances, for example, let's say for property, plant and equipment, there is some machineries which is like lying on dockyard and company is not using it. And ideally that machinery need to go for impairment testing and need to reduce the value, right? So rather than reducing the value, they have not reduced the value of that. But whereas like the other asset, they might have sold and they have booked the loss. So in the overall financial state, instead of profit, in the overall financial statement, the amount may become approximate to the same what it has to become. But if you see, there are two type of misstatement. One is impairment loss on one asset has not considered, and second, the profit on sale of other assets has not considered appropriately. So both need to be considered appropriately, even though the total outcome or total result on the balance sheet and profit and loss account will remain same. Make sense? Yes, no?
Yes, sir.
Are you getting
Yes,
my
sir.
point? What I'm saying, like in the property, plant and equipment, one asset which is not, company is not using, is supposed to go for an impairment loss, and the company has to book, let's say, $100,000 impairment loss. And the other side, they have sold certain property at a profit of $100,000 and they have not booked the profit. So even though, like, if you see the in the overall profit and loss account and balance sheet, amount is coming right, but ideally they need to book both the transactions separately. One loss need to go into the loss and profit needs to go into the profit, even though net impact on P&L is neutral or close to neutral. Right. Next is likelihood of misstatement is currently immaterial, may have material effect in future period. So there might be possible that misstatement you have noticed now may not be too much material to the financial statement currently, but in future it may result into a bigger misstatement. Right? Risk of possible undetected misstatement. So these all are qualitative factors which you need to keep in mind when you are evaluating the misstatement, and when you have identified any misstatement, whether it's a corrected or uncorrected, that come later, right? As and when you have identified the misstatement, you need to look at qualitative factor and the quantitative factor both. If you see the note over here, if aggregate of misstatement.
A question, just second last point है, likelihood that misstatement is currently immaterial may have a material effect in future period. इसका कोई example जो practically देखा हो?
So for example, let's say for automobile company, I'll give you an example from General Motors. Automobile company, they have come up with a new, you can say, base, or you can what you call chassis, new chassis for the new vehicle they are planning to launch. Let's say Tesla is planning to launch EV vehicle. So for that, they have created a separate platform which is supporting the EV engine, not the petrol engine, not the gas engine, not the diesel engine. So that's a altogether a new platform they have developed for the new EV vehicles. Right. So as of now, currently, let's say in the year one, they have sold, let's say, 5,000 EV vehicle on that platform, and on that, from 5,000 EV vehicle, they got, let's say, maybe 200 as a warranty claims. So if you see 200 vehicle out of the overall Tesla sale of, let's say, 100,000 vehicle might not be material, at less than 0.02%. Right? But whereas if you see the future dynamics, company wants to increase their sales of EV and reduce their gas vehicle sale or diesel vehicle sale or petrol vehicle sale. Right? So strategically, if you see today, the impact is very less. But in future, the company strategy is 50% they will be selling EV vehicle and 50% they will be selling fuel vehicle. Right? So in future, the impact might be bigger. Make sense? So,
Thanks.
right? So they need to fix the problem right now. Otherwise, in future, the problem would be bigger as per the business plan of the company. Yeah, everyone? Gurmihar, Vineet, Rahul.
Yes, sir, all good.
Yes, all good.
So if aggregate of misstatement identified approaches to materiality level, auditor should consider the risk of undetected misstatement. The auditor should reconsider the nature, time, and extent of further audit procedure. So if you have identified any material misstatement or misstatement which is close to materiality level, so then you need to reconsider the nature, timing, extent, and required to perform additional audit procedure around that particular area. Documentation, work not documented,
Work not done.
work not done, right? So all those critical area, you as an auditor, it's mandatory to have sufficient and appropriate documentation. So what all things you need to document? First one is materiality and tolerable misstatement for that particular financial statement line item in which you have identified any misstatement. Uncorrected misstatement. So within the uncorrected misstatement, you need to separately consider the effect of non-misstatement and likely misstatement and effect of what is the other kind of misstatement? First is non and factual, second is likely or projected misstatement, right? So you need to separately disclose what is non and factual misstatement and what is likely and projected misstatement. Second is prior period misstatement, if any. Third is aggregate effect of the misstatement. So these things for any uncorrected misstatement, you need to separately disclose. I know some of you are working in like consulting firm. So I'm sure you may have separate template for the uncorrected misstatement. Have you guys seen those templates for the documentation of uncorrected misstatement?
Yes, sir.
How does it look like and what all information it has?
So primarily, we kind of capture what exactly the transaction is, let's say the journal entry, and what's the impact, and then accordingly, what should be done, like the suggested fees. And like usually I know that we have SAP template, and then we also have a corrected or uncorrected misstatement template, which is more like an Excel file with multiple tabs, and it captures all of that basic information and the dollar value and the impact that it has.
Yeah, Nimisha, you want to add something?
Only one point to all these tabs, specifically to uncorrected misstatements. There's also a nature and cause of misstatement section, and then generally any misstatement that is there, that is identified in audit has a corresponding control deficiency attached to it. So we also have to give the details of what the control deficiency is and what is the management done to rectify that.
Yeah. Do you mind sharing like a quick image of that to in the group for the benefit of everyone, so that everyone can visualize like how actually practically it's been done in consulting firm?
Yeah, sure. I can.
Yeah, so yeah, that will be very helpful for everyone. Like generally like CPA firm, whether it's like mid-size, small size, or you can say big giant firm, they have standard template for documentation of this. Now this is like kind of mandatory documentation. So what all things mandatorily you need to document, like class of transaction, nature of transaction, overall amount, materiality, tolerable limit, what is misstatement you have identified, how much out of that is known misstatement, or how much out of that is likely misstatement, is there any impact from prior period, what is the aggregated impact on current year numbers, and the conclusion, how you have reached to that, right? And then like whether it's being like material to the overall financial statement, and how as an auditor you are concluding the impact of that uncorrected misstatement. Are you going to qualify the report, or you're going for a management recommendation letters? And those all things you need to be document properly, and respective controls as well, like Nimisha said. So if there is any control deficiency around those areas, that also you need to document properly. And communicate material misstatement to appropriate level of management, and wherever needed to those charged with governance, and understand the reason from management why they are not making correction before forming any opinion. right? So all the misstatement you have identified, you'll be discussing with the management first, right? For some of them, management do the correction, and some of them management may not agree to it. So the misstatement which you have identified for which management do the correction, then you just need to document and done. The misstatement which you identify and management is not comfortable to make those correction, then you need to understand from the management what is the reason why they are not agree to it. And then you need to document the management rationale and your conclusion why you feel this is a misstatement despite of the fact that management is not agreeing to it, and the reason of why management does not agree to it. Right? Make sense? So this is about misstatement.